Happy that so many of you join us today. I just wait your time and then as we start. Okay, good afternoon, ladies and gentlemen. Welcome to our 10th local final of CFA Research Challenge. My name is Krzysztof Jajuga and I'm the president of CFA Society Poland. We are organizers as a CFA Society of this event, let's say, of this competition actually. Just very brief information before we go to some speeches and in competition. First, this is, as I said, the 10th local competition. As you know, CFA Research Challenge worldwide competition. This is #1 competition, students competition finals in the world, by no doubt. There's no other competition that is so prestigious that CFA Research Challenge. And actually in the world, this is number 13 already, but we started as Poland in 2009, and then first final was in 2010, of course. The number of teams is growing, of course, and I'm extremely happy. This year we broke the record because there is 32 teams that registered and started. Actually, there were 26 reports delivered, and we have today 7 best teams in the room. I don't give you the name of these teams, but I will give you a letter for each team very, very soon. And just to recall what happened in the meantime, in these 10 years, we started from very, very few students' teams, maybe 3 or 4 in the first edition. And as I correctly remember, the first company that was researched was Amrest. And then we had Warsaw Stock Exchange, then we had Bogdanka, then we had KGHM, then we had Comarch, then we had Netia, then we had CCC, then we had Cyfrowy Polsat. What was that? I think that's mostly the project, of course, so that counts to 10, I think. This year we have PKN Orlen. So I think that last several years, the winning team or winning teams from our local competition, they started each year in the regional competition, which is EMEA, Europe, Middle East, and Africa. And the regional final will be on the 10th and 11th of April in Zurich. And 2 best teams will go to the regional final. So I think in the last 6-7 years, maybe there was one exception. The team from Poland didn't get to the very strict final of best 5 teams in the EMEA region. So, you know, always when I think there was one case when you didn't get to this final, they said, this is big upset, big surprise that Poland didn't get to the final, to the regional final, I'm saying. And as you probably remember, as you know, probably in one situation, team won regional final and then one global final. That was Wrocław University of Economics. That was in 2013 with the KGHM report. So again, these are rules basically, and most of you know them. I think that, the global final, it will be in New York this time, and depending, I'm not sure yet, but depending how many competitions were organized in EMEA region, if this was at least 37 competition, last year I think it was 37, so 2 teams were sent to the global final from EMEA region. And last year, 2 teams, that was Oslo and Lausanne won global final also. So that was the 3rd case that European team won the global final. Before there was Milan and Wrocław and now Lausanne, and they are winning team from last year, of course. So that's basically it, what I wanted to say is saying about the origin of this competition. First, I would like to congratulate also those teams because you spent 2 months of your time on preparing reports. Reports are very good. Judges, graders actually, because we divide judges among 2 groups. Graders, they graded your reports. Of course, they didn't know who wrote this report. And then we have panelists. They will be soon introduced. They will judge you as far as your presentation is concerned. So you really are extremely good teams. And as this grader said, these are professional reports. So you probably have a good starting point before you go to business and you start to write these reports for the business purpose, not just for exercise like here. Okay, so I would like now to ask, first of all, Iza Olszewska, Deputy Chairman of Warsaw Stock Exchange. I have to say the Warsaw Stock Exchange from the very beginning was our partner from the very first edition. And even in the second edition, Warsaw Stock Exchange was subject company because that was the year when Warsaw Stock Exchange became public, 2011, I think, or 2010. And that was the reason that also was the subject of research. So Iza, the floor is yours. Please say a few words to our guests.
Good afternoon, ladies and gentlemen, dear students. First of all, I would like to welcome all of you at the Warsaw Stock Exchange premises in our trading floor on behalf of the host of the Warsaw Stock Exchange. My name is Izabela Olszewska, as Professor just kindly introduced me, and I'm the member of the management board of the Warsaw Stock Exchange. And first of all, I would like to say that I'm very happy to see here in this trading floor so many young, I would say, international faces. But from the perspective of the exchange, we are very honored to be a partner of this project, CFA Institute Research Challenge, and the local Finał organized here in Warsaw. And I think that this partnership is very natural for the Warsaw Stock Exchange. First of all, as a middle-sized exchange in Europe, but the biggest exchange in the Central and Eastern Europe, we offer to the companies, to more than 800 companies, our trading platform. And on the other side, we provide through our members, through broker-dealers, the access to our trading platform for different kinds of investors. And I think that it's extremely important to have the tool for these investors to enable them to get to know the companies listed on the Warsaw Stock Exchange, and also to allow them to assess if this particular company matches the investing preferences. And this is the one reason why we are the partner of this project. The other reason is that the Warsaw Stock Exchange supports educational activities, not only in Poland, but even widely in the region. And one of our flagship projects is Exchange School or Exchange Academy, which is provided in every academic center in Poland, in different cities in Poland. And here in this educational area, we have a long-term cooperation with CFA Institute, so we are very proud of it. And I would like to thank to Professor Jajuga and CFA Society Poland because we organized together a lot of, I think, valuable initiatives. So using this opportunity, I would like to wish all of you a very interesting and useful time here in Warsaw today at Warsaw Stock Exchange premises. Thank you very much.
Thank you very much. Now I would like to say a few words, Mr. Michał Perlik. Michał is investor relations in PKN Orlen, and as you know, PKN Orlen is this year a company. So, Michał, floor is yours.
Thank you very much. Good afternoon, ladies and gentlemen. First of all, I wanted to thank you once again, to Professor, to CFA Society Poland and CFA Institute for inviting us to participate in this event, in this initiative. It's a great privilege for PKN Orlen to be a target company in CFA Research Challenge. I also wanted to congratulate to all the participants being here today with us. I believe it's the fact that you are here with us is already a great success of yours, not only because your reports has been assessed as the best ones, but also or mainly because you managed to prepare research reports on PKN Orlen, having in mind how complex group it is and having in mind how complex sector is oil and gas. I wanted to wish you all good luck today, and may the best team win. Thank you very much.
Thank you very much. As you see from this board, we have many partners. I would like to thank all the partners, but first of all, I would like to thank our strategic partner, Deloitte, and Tomasz Ochrymowicz will say also a few words. He's in the jury, but he can say a few words.
Thank you, Professor. I understand this is 10th anniversary or 10th competition, so I get to speak for 30 minutes, right?
How many?
30 minutes. No, just kidding.
Just skip 0.
All right, 3 minutes. All right. Everybody, thank you for coming here. You've made it so far. Congratulations. When I was taking my CFA exams 20 years ago, there's probably 3 rows of people sitting the exams. And this is heartwarming to see such a crowd today. 7 teams, well, 32 teams starting, 7 teams qualifying. Congratulations to everybody for making it so far. Congratulations to your fans. The 7 teams, good luck today. Bring your A game, and once again, good luck.
So again, my thanks goes also to other partners, especially Bank Gospodarstwa Krajowego. You are with us for the 2nd or 3rd year, if I correctly remember. Thank you very much. And of course, Giełda and Fundacja Giełdy Papierów Wartościowych, they are from the very beginning. Thank you very much for this. I also would like to express my big thanks to all mentors and faculty advisors that prepared teams. Some of them are here, not all probably. We have a chance also after this competition. There is, for the first time, we decided to organize on the 10th anniversary gala, which is not very far from here, 200 meters or something like this. So it's after, just briefly after competition, straight away we go there, and then we could maybe celebrate even more. Basically, I also thank my team, Monika, Jakub, and Ewelina. They will play also an important role here, because Monika decided, what is Monika? Oh yeah, she's here. She decided to take very important role as a timekeeper, right? And then Ewelina has a very important role because she will guide you to the room where you stay when your other teams are presenting. This is general rule that when one team is presenting, other 6 teams are outside. So Ewelina will take care of this. Okay, I think I can start this presentation very briefly because there are some things mentioned. Okay, can we go? Oh, there's 0, sorry. So again, presentation of our partners and strategic partners. Rules, you know the rules, of course, because you got these official rules before you start even write your project, your grant. There'll be presentation of 7 teams, and then very short, I should say, maybe not very short, break when judges will provide scores, and we have to put all these scores together and decide about final announcement about the winners. So that's basically the main idea. I just want to present our jury, our panel. There are 6 panelists. We should start from Dagmara Zawadzka, of course, lady. Dagmara is managing director of sales in BGK, Bank Gospodarstwa Krajowego, our partner. And then we have our guest from Abu Dhabi, William Tome. William, is it your 3rd or 4th grading session? 4th, okay. So William just came yesterday for the very nice event, which we had exactly in the same room, that was the Club of Women of Financial Market in Poland, and she had a presentation. Also, we had a very, very well-known lady who directed several movies, including Moje córki krowy, as you know probably, and then also Zabawa Zabawa, this new movie, Kinga Dębska. Okay, we have also, I'm just going from the bottom, Piotr Sieradzan, CFA. Piotr is the vice chairman of the CFA Society Poland, and also, of course, managing Everest Investment. I hope this will be Mount Everest soon, right? Okay. Then Tomasz Ochrymowicz, you know already Tomasz. Tomasz is from Deloitte, managing partner and financial advisory. Oleg Mokrzycki, CFA, also member of our board, so deputy chairman, as you can say, in the board. And also Oleg is in PFR Ventures, so very important institution. And last but not least, Michał Kobza from Warsaw Stock Exchange, Director of Market Development Department. So these are judges, and then I just want to say general rules. There are 7 teams. I will read. We had a draw of the order of presentation before we started. Then there is, of course, each presentation contains investment recommendation, buy, sell, hold, whatever, okay, and target price. There's time, 10 minutes time for presentation, that's sharp. So after 10 minutes, there's a buzz, and that's it. You have to stop immediately. And then there is, after this, there is 10 minutes of Q&A. Judges, panelists will ask the questions, also 10 minutes together, not 10 minutes each judge. That would be too long. And then, of course, the combination, we have 50-50. 50% of score comes from reports, which is already decided, and then another 50 from today. Basically, this is general rule, but however, those teams, I hope, who win a semi-final in the regional final and go to the strict final with 5 best teams, then only presentation decides, no longer report. And the same is true for global final. There's only presentation which will decide about the winning team. But now report is also taken into account. And then, of course, mobile phones off, cellular phones off, whatever, smartphones off. I remember these names are changing when you go for the conference in the US. Let's say, years ago, they say, please turn off your Blackberries. Now, not too many people, well, in the US, I think they still use, but not that many as using other types of smartphones, let's say. Audience should remain silent. I'm extremely glad that there are so many people in the audience. I know that there are more people than teams here, than participants from teams, because 7 times 5 is 35, and there's much more people here. So you have to remain silent, and not because that's disturbing, of course. This is presentation scoring. Judges will have this scheme, of course, and these are rules that were imposed by CFA Institute Research Challenge team. So you have 100 points, and each part has some number of points, so it's not equal number, of course. That's basically it, I think. We have target company again. Well, we decided, you know, because target company usually is the company that is taken because it is a good company, but also it has some kind of story. And the winning team should present the story when going to the regional final, right? Then maybe not everybody from judges will know exactly what is Pekka Orlen if somebody is from, I don't know, from other country, and certainly there will be somebody from other countries. So story is very nice. So we usually try to select in our board team which is probably has not story, which does not mean that this is easy to value, right? As you know from your report. And these are the dates. I think this is the most important, 10th, 11th of April. And I hope that one team from this final will win also regional final. And then there is New York. Of course, this is 25th of April, because in New York there will be America's final before global final. So they just want to do this at the same time. Good luck. So I think now important thing is that there was a draw of the order of presentation, and I'm just slowly, you know, judges also will know this draw. The first presentation will be given by Team H. The second presentation will be given by team Q. The third presentation will be given by team P. The fourth one by team U. The fifth one by team O. The sixth one by team V. And the last one, seventh, by team R. So we managed to use just one letter, although I should tell you that with the reports there were also double letters because there was not enough letters for each team, so we have to use also 2 letters, but not here. Okay, so I would like to ask Ewelina just to take all 6 teams except for the team H. Team H stays here, and you come to the stage. You have made small preparations, and then we are going on. Okay, thank you very much.
Isn't that presentation with that guy?
Because people want to have it here, just that you can change the slides. Let's see.
Because we talked with Evelina and she said that everything's all right
Is
if we
it?
send it. Yes, it is. We see that.
Yeah.
Okay.
So it's you just launch
Yeah.
it, and we are ready. You just say yes,
Yeah.
and then we start
Okay.
to count the time.
Yes? Yes, okay. Windows L. Verzorgen.
Nu werkt ik jou al.
Ja, wat doe je? We just pressed the wrong button with Windows.
Oh God, because
Sorry.
there is a password.
Yes.
So if you are ready, you just give a sign, and we start.
Yes. But presentation is not ready because computer is locked. So.
They have to fix it. Stop.
Sorry?
Oh, sorry. You want to go and change the slides by yourself?
We have pointer.
Yeah.
Yes, we will change.
We want to change by yourself.
Yes.
It's,
Yeah, but it's locked.
Is it why? I used this before and it was okay. Nie wiem, no ja... I just did this and I used this. Yeah, we wait for the guy. Aha, tu tu jest hasło jeszcze. They didn't ask me, they didn't ask me.
Can you please start the presentation?
Okei, provided we have cut radiator, right?
Yes,
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 yes.
we can start
Don't
now.
see this here.
Yes, because
Because the guy
the
will.
guy will.
Jesus Christ, this is so complicated. Okay.
Yes.
Okay, let's start.
Okay, so finally, good afternoon, ladies and gentlemen. We are Team H, and we are pleased to present to you our research report on Orlen with a final recommendation of hold, since their upside is 1.8%. So for those who does not know Orlen, it mainly operates in 4 main markets: Lithuania, Poland, Germany, and Czech Republic. And it divides its operations into 3 main segments. The most profitable one is downstream, which includes all the refining, production of chemicals, logistics, and energy. And it is followed by retail, which we all know from service stations. And the third business segment is upstream, which means exploration and production of crude oil and natural gas. The main goal of the company is to stay relevant and to cooperate more with startups, and it reflects in Orlen's short and medium-term strategies. Now, I'll give my word to colleague to tell more about the industry.
Okay, hello everyone. The macroeconomy in Orlen's home market is very promising. It has been growing for the past 7 years, except for the Czech Republic, had a small downturn from 2012 to 2013. However, it recovered relatively quickly. Analysts from IM, International Monetary Fund, predict that there will be an economic slowdown in the near future. However, the economy will remain to grow at 2%. The crown jewel of Orlen is their retail business. They're currently dominating Poland and Czech Republic's markets. Their competitors come nowhere close to their dominance in these markets. Another market in which Orlen excels is wholesale. They currently have above 50% in both Poland and Czech Republic markets, and they totally dominate the Baltic market, where they have around 75%, 7% market share. The last industry in which Orlen operates is petrochemicals. They are currently responsible for 70% of PTA manufacturing in Europe. Also, petrochemicals has a really good potential in the nearest future. Analysts say that the petrochemical market in the upcoming 15 years will grow exponentially and should double within the next 15 years. Orlen is operating in two other segments: power generation and upstream refinery. They do not sell these products, but they do bring a lot of value to the company as a whole.
Now it's time to give a couple of words about competitive position of the company. So first of all, I would like to discuss the threat of substitution. Orlen faces a couple of difficulties from this side. There is an emergence of shared mobility services like Uber and Limebike. Limebike is a service sharing e-scooters, and Uber is ride-hailing. Another is increasing fuel efficiency. People are getting more and more interested in using energy effectively. So people getting in this industry, they're using new technologies, everything they can use to get fuel consumption effective. Talking about biopower, we believe that the company managing with this side quite good, because the lowest level that the power has some power is retail business. As well, the company has diversified their portfolio of customers quite well. They are exporting to 90 countries their production. As well, there is some federal legislations as well. Talking about supply power, we believe that the company has done a huge job by decreasing reliance from Russian oil. But still, there is a huge number over there, because 70% of all crude oil imports come from Russia at this moment. Talking about competition in the industry, we believe that it's a moderate one, because competitors sometimes act as suppliers, for example in Germany, to the company. And of course, companies are trying to avoid all destructive price wars. Talking about new entrants, we believe that downstream and upstream has quite similar barriers of entry. For example, both segments faces capital intensity, government and environmental barriers, need for differentiation, need for competitive advantage. On the right, you see how the company deals with that. For retail business, we believe that it's more fragmented one. And as you can see from a graph, more than 40% of all gas stations in Poland are owned and operated by independent stations, by independent owners as well. Yeah. My colleague will proceed.
Moving on to financial analysis, over the last decade, Orlen sales revenues were quite volatile. We found that this volatility mainly came from downstream segment, which is highly correlated with oil prices. Also, revenues are affected by sales volumes, which are influenced by companies' production capacities and demand. For the upcoming years, we forecast that the revenue will decline and later will slowly grow, because oil prices are forecasted to decline in 2019, but after that stabilize, and sales volumes should slowly increase due to industry trends. Speaking about cost of sales, they are over 80% of sales and are highly related to revenues because of the same main drivers. More significant change only happened in 2015 after acquisition of a refinery, which resulted not only in an increase in capacities, but also in reduction of cost and rise in EBITDA margin. However, currently Orlen EBITDA margin is still quite low between peers and industry. And in the future, we forecast that EBITDA will slowly grow while maintaining a stable margins. On the other hand, company is quite well manages its liquidity because ratios are improving and are in line with peer averages. And although cash conversion cycle is lower, longer than peers, it is stable with only minor fluctuations. Also, Orlen has lowered the proportion than peers and industry, which means less risk and cheaper borrowing. But at the end of 2018, debt levels started to increase, and we forecast that the trend will continue in the future due to Orlen aim to increase capital expenditures to implement new projects. To value Orlen, we use relative valuation and discounted cash flow model. For each of them, 50% weight was attributed. And we got a target share price of 107. In absolute valuation method, we use free cash flows to firm, where we forecasted first 3 years, and then we increased free cash flows with long-term growth rate. For discount rate, we found weighted average cost of capital, which consisted of cost of equity calculated using capital asset pricing model and cost of debt. And our discounted cash flow model gave us the price of 100. In relative valuation, we have chosen 8 competitors, and by using median EV/EBITDA ratio, we arrived at share price of 113.
One of the main and most unpredictable drivers which affect Orlen results are oil prices, so we made 4 scenarios to evaluate the impact of it. The results show that our recommendation would not change even if the price of oil would increase or decrease, resulting in a share price of 100 at the minimum and 116 at the maximum. Furthermore, the sensitivity analysis, where we altered weighted average cost of capital and long-term growth rate, showed that our recommendation would be changed to buy or sell only at extremes.
The company is currently exposed to some risks, but the management is very well aware of them and they are handling them quite well. By investing, by lobbying government, or other means. Our analysis has indicated that some of these hazard mitigating procedures does come at a cost. However, in our opinion, the benefits outweighs the cost. Thank you for your attention, and we are ready for your questions.
Okay, so now we come to questions and answers, and if Julie is ready, if you are ready, we can start to count another 10 minutes. Okay? Yes. Okay? Yes. Start. Whoever wants.
Thank you for the presentation. If you could, because it was really briefly, the valuation was really briefly described. If you could point out the main drivers of the company value in both terms, in terms of DCF and the relative valuation.
So the main drivers for sales volume was macroeconomic conditions, petrochemicals growing market, increasing demand because of decreased prices, and production capacity slow increase.
Okay, but I just want, I wanted, if you could just provide main financial assumptions of the, for example, DCF. We can see the cost of capital, but what about the margins? How the margins are working? What would the assumptions of the financial projections?
So the main assumption was oil prices, because in historical fluctuations we notice high correlation with oil prices. And also, we noticed that demand is moderately correlated with the prices. So that was our main assumptions.
Thank you very much for the presentation. I think it was quite complex, but you didn't comment on the financial leverage of the company. And in case of PKN Orlen, it's quite low. It's at the level of 16%. And my question is whether you were thinking about the possibility of raising the value through the better use of financial leverage. And if so, what kind of projects could be interesting? What kind of new line of business for PKN Orlen to develop?
So as we said during the presentation, we project that the debt level will increase. It has increased during 2018. And in the future, we project that it will continue to increase due to increase in capital expenditures.
What kind of projects could be interesting?
Capital expenditures are in capital expenditures. There's included a new refinery and I believe moving on to biofuels and to more focusing on the petrochemicals.
Question about margins. First, you said there's correlation between oil price and margins. What is the correlation? What does it tell you? Second, why has Orlen lower margins than competitors? And the third question would be about residual growth. How did you come up with this number?
So about correlation, it was, I didn't remember exact number, but it's about 80.
Yeah, it's about 80%.
Okay, I get it. It's high. What is the relationship?
Of course, there is a strong relationship because PKN Orlen, the company, their main product is refined oil products like diesel, gasoline, jet fuel, and so on. So it's no way that the correlation would be lower. We are buying crude oil, refine it, and sell it off. So that means that if crude oil decreases, the price of it decreases. So refined products prices as well decreases.
How does it impact margins?
About margins?
How does it impact margins? How does it impact margins?
Margins remain the same because cost also fluctuates with all prices. So margins remain stable.
So there should be no correlation. The second question, the difference in margins between Orlen and competitors. You said 8% EBITDA margins for PKN Orlen, or 9%, and 18% for MOL. Why there is such a huge difference?
Well, the company, in our belief, of course, regarding our research that we made, we believe that the scale of PKN Orlen is actually huge compared to other competitors, and when you have a huge business, it is more difficult to control that margin. And we believe that those other businesses, being a little bit smaller, they have capacity, and it is more easy to do them. That's it. Did I answer your question? I tried.
Residual growth.
Long-term growth rate?
Yes.
We took Poland's economy long-term growth rate as our long-term growth rate because Orlen mainly operates in Poland economy and it's a large and stable economy.
Okay, you discussed downstream revenues, and I've got a question regarding retail revenues. What's the logic behind your forecast? Because since retail is responsible for like 1/3 of revenues, I see the forecast rather flat until 2021. And can you just provide some explanation what your assumptions behind it?
So revenue forecast is for all segments, not for downstream and for retail. So we, in our calculations, we took into consideration common effect from sales volumes and from all prices.
Okay. So what about the dynamics? What do you think the dynamics of revenues, retail versus downstream, which is?
Retail is not so sensitive to all prices as the downstream. Downstream is more sensitive.
Yes, because retail segment there is like a possibility to buy food, you know, other stuff. So because of one regulation here in Poland, the company is willing to get up to 100 million Polish zloty next year. In this year, actually, 2019. Yeah.
Okay, thank you.
Okay, sorry for my voice. What do you think of the ideas of merging PKN with Lotos, and why?
It's a very, very good idea, and we actually didn't include in our evaluation Lotos because there is a deal on the table in European Commission, and it is not certain. There is, I think, a possibility that this deal will not come to reality. But this deal, if it will become a real, and you'll actually picture only if merged with Lotos, it will be perfect, because the Lotos is the second largest company here in Poland, and having as well they have like 50% state-owned company. Lotos is while Orlen is 27% owned by the government. So it will be, you know, a huge company, partly owned by the government, and it would be perfect because the competition would be just a little bit smaller for now. Do we answer?
Well, I don't quite understand why being big is enough to be great and successful, and I don't quite understand why the companies that merge generate a perfect merger. In your opinion, I didn't get this.
Because the competition will be smaller in home markets, in Poland especially. You are just lowering your competition. Any questions?
Did you take into consideration the renewable energy threat to the oil industry?
Thank you very much.
So,
No, we asked.
You asked?
Yeah.
Permission? Too bad. That's the first case in history, but okay.
Yeah, I didn't get the piece ready for with the remote control. It's okay? Yeah, okay. Go there, go there.
Come here.
Yeah.
Hello, testing. Good afternoon, ladies and gentlemen. We are pleased to present our analysis and hold recommendation for PKN Orlen, an efficient refinery in a turbulent environment. PKN Orlen is the largest refining company in the Central and Eastern Europe and the second biggest on the WIG 20 index. It operates in Poland, Czech Republic, Germany, Canada, and Baltic countries. The group owns an integrated infrastructure capable of processing more than 35 million tons of crude oil per year, offering over 50 products and marketing them through the largest retail network, CE largest retail network. The company operates in 3 different business segments. Downstream segment that operates in the wholesale of refining petrochemical products is the segment that drives the company value. Retail segment, through the service stations, sells fuel and non-fuel products and will remain important for the company due to its expansion plan. The upstream segment that operates in the exploration and extraction of gas and of oil and natural gas has a minor impact on the company's financial. PKN Orlen has outperformed the WIG 20 index over the last 4 years, boosted by favorable oil price fluctuations. The company's multiple valuations remained close to its peers, suggesting that the market-wide phenomena affecting the commodity markets have been responsible for the sustained growth. But the best times for the refining business seems to be over due to constraints in supply and growing macro uncertainty. Our hold recommendation is underpinned by 2 crucial factors. First of all, the company seems to have hit an internal growth boundary that, with its current capacity utilization, leaving no room for further operational improvements. Secondly, uncertainty seems to be mounting both in industry and the market and the macro environment. We expect a small increase in the oil price for 2019, pushing slightly down the EBITDA and operational margins.
Indeed, ladies and gentlemen, it's all about margin. We can clearly see from this graph the strong correlation between EBITDA LIFO and the stock price. Despite the company disclosed recently an EBITDA lower than what investors expected, we can clearly, we are sure that the EBITDA margin will stay stable next year. The refining margin is languishing. Languishing mainly because the higher premium fuel, the maximum capacity utilization, and the new capacity openings in the US and Mexico. For that reason, we expect shrinking profits in the wake of the increasing global supply. The refining margin will be mainly driven by the IMO regulation, since shipping companies are obliged to shift from heavy fraction to medium and light distillates. The refining company probably will follow the demand. The jet fuel, in the meanwhile, will contribute to support the stable demand for medium distillates, and the light distillate demand will be robust as well, because since we don't see any threats from electric mobility. For these reasons, the diesel margin will overperform, while the gasoline margin will underperform. The Brent-Ural differential is under downside pressure as well, because of the new, recently completed upgrades in the Russian refineries, and the increasing demand-driven exports from Russia to China, which will push the price of Ural oil in relation to the Brent. So narrowing down the Brent-Ural differential. Orlen results and margin are heavily dependent on oil. The growing demand in emerging countries are driven mainly by India and China, while the increasing supply will be driven by the OECD countries. The slight difference between supply and demand will push the price of the oil about $73 per barrel in 2019. The petrochemical margin is under pressure as well because of the rising price of naphtha, the weakening of the exchange rate US-Euro, which may foster the imports from outside Europe, and the increasing in supply from the United States will put downside pressure on the product prices.
The model downstream margin has plateaued during the last 2 years, mainly because of the lower inventories in our region and because of the seasonal pattern. Our expectation concerns a cyclical slowdown because due to the increasing in supply, which is set to outstrip the demand growth. For this reason, we forecast a corridor among between 11 and 12 USD per barrel. PKN has already planned non-organic growth through the acquisition with Grupa Lotos. In this case, we are skeptical about this transaction for 3 main reasons. Number 1, in our opinion, the uncertainty surrounding the deal completion stemmed from the regulatory approval. Indeed, this merger would lift the entity share in the retail market in Poland above 40%, which is the maximum allowed by the anti-monopoly regulation. Number 2 is that apart from market consolidation and cross-border diversification, we are not able to identify any potential synergies because both companies share the same core business and the same range of products. Number 3, market price as a deterrent. Why? Grupa Lotos is currently very expensive. The current valuation supports a current price that is so high that PKN will definitely overpay this company. Moreover, we run a fundamental valuation on Lotos, and this company seems to be perfectly fine on its own. Finally, PKN has already planned a cross-border diversification and is increasing the product offer. Also in this operation, we cannot identify any value driver because we estimated a revenue growth of just 1%. Again, it's all about margin and oil price.
In addition to stable but languishing margin, the company enjoys a stable financial position, allowing a regular dividend policy which makes the stock attractive to investors. For the valuation, we were based on discounted cash flow and multiples valuation. It resulted in a null recommendation with a blended target price of 109 Polish zloty, offering a slight upside. For the discounted cash flow, we used the free cash flow to firm. We made a 6-year projection with a WACC assumption of around 8% and a terminal growth of 0.43%. For the multiples analysis, we consider a pool of peers based on GPRV analysis, gross profitability and risk, which in short drive value. This valuation approach describes PKN Orlen as a fairly valued company. To complete our analysis, we extracted the key risks for PKN Orlen, namely the changes in regulatory environment due to the upcoming IMO regulation, but also the fluctuation of commodity price, since revenue are highly dependent on oil price. From where we stand, we have seen that margins languish while uncertainty mounts. Thank you for your attention, and the floor is now open to questions.
I would like to know what, in your opinion, are the main the main strengths and weaknesses of the company and how they influence the valuation?
Okay, in our opinion, the main strength for the company is the high efficiency, is a refining company, so it has efficient capacity utilization, and moreover, it is able to well manage the margins. And the second question is about what, sorry?
Strengths and weaknesses, and how they influence or potentially could have an influence on the valuation.
Okay, and the weaknesses, in our opinion, are the willingness to expand cross-border, because we don't consider these operations as value drivers, and the transaction with Lotus that because we are not able to identify synergies in this company. In this merger. Regarding the valuation, we included these margins in our cost, so we expect that a change in the cost will influence our final valuation.
I have a question concerning diversification of crude oil supply. A few years ago, the company was taking crude oil mostly from the Russian direction. It was 95% a few years ago, and now only 70%. And according to the strategy, the company assumes further diversification of crude oil supply. And I would like to know your opinion how this will influence the value of the company. Is it positive or negative aspect?
We pursue this strategy as a good strategy for the company. We have read that the company does not have any, actually that the Russian, it was heavily dependent on the Russia refineries, and now it's diversification, as you mentioned. And we only pursue this as in our risk metrics. So basically, this did not play any role in our evaluation or in the intrinsic value of the company.
A couple of questions about DCF model. Why have you selected 6 years horizon, and justify your terminal growth rate, please?
Regarding the first question, we decided to go for a 5 years projection plus the terminal growth, the terminal year. That's why it was a 6-year projection. And regarding the
why? Why not 10 years? Why not 3 years?
Because we believe that this market is a very volatile market. It is very difficult to predict in the next 1 or 2 years. So
you assume 1% growth, no volatility. Where is the volatility? 1% growth is not too volatile.
We perceive that is a stock that is considered commodity stock.
So?
That's why the volatility comes from the oil market.
Okay.
And regarding the growth rate,
the residual growth rate, the terminal growth rate?
The terminal growth rate is based on fundamentals, and we believe that this terminal growth rate reflects the future of the industry in the long term.
Okay, so explain more. What do you mean?
Well,
you assume 1% growth throughout the 5-year period, then 0.4% in the residual growth rate. What are the macro drivers that are driving this residual growth rate, and why is it lower than in the 5-year period?
We believe that this industry will shift for renewable energies. So refining companies will rather be petrochemical companies, and refining products will be rather input for the petrochemical products. So that's why we forecast a low value for the terminal growth, reflecting the long-term perspective of the industry. In this, if the refining companies do not shift the core business, it can face financial constraints.
Okay, so I will just maybe add something to the previous question. So if you said that this company is all about oil and oil prices and the refining margin, so where, in what scope, geographical or like product-wise, the company should look for additional value?
Because in our opinion, geographical expansion does not add any value, because the core business of the company, as we said, are the margins. So an efficiency in the margins could add value to this company.
Here, if I can add something, we can also take into account the record with the acquisition of Unipetrol, which didn't bring additional value to shareholders, even if it added certainly geographical expansion.
Okay, thank you.
You seem to be quite confident on your oil price forecast. Well, in the current times, what makes you so confident? And my second question is about your opinion on the current management of the company.
Okay, we in the short term for the oil price, we forecasted an increase in a robust demand and supply. There will be just a small mismatch that, in our opinion, will slightly increase the price of oil. Regarding the management, in our opinion, this company is well managed because they actually manage well the margins. These are highly efficient, and the utilization capacity is highly efficient. The only possible inefficiency that we can find is the willingness to expanding with the non-growth, with the non-organic growth. That, in our opinion, is not the key value drivers for this company.
And if I can add some information about the supply side of the oil, the supply side could be exposed to shocks because of the U.S. sanction on Venezuela and Iran, and as well as a slowdown on U.S. shale oil is decreasing the growth of this fuel, and as well as the cut production agreement signed by OPEC plus countries that can affect the oil price.
You mentioned that the management is good because the margins are high. The margins compared to European peers are rather low, not high.
But the company has always outperformed the stock market. So for this company, these margins are in line with the market in Poland. If I'm not wrong, the cumulative return from 2015 to 2017 has always been around 100%, if I'm not wrong. And so I would say that the company is definitely managing well the margins. But in 2018, the oil price increased and the company results were a bit less favorable than the period from 2015 to 2017.
You said the management is good, but if you were to give two pieces of advice to management how to improve performance, what piece of advice would you give it? Would you give them?
I would invest I would invest actually in the new technologies, and I will prepare the company very well to the IMO regulation that is going to shift the demand to light and medium distillates. So there's this new technology that is device braking that can help to waste less residuals and to optimize the production of light and medium distillates.
In addition to that, we can say that the company should not pursue non-organic growth while the market is not favorable to.
What about upstream? The passive strategy of this management board is good?
Not that good, but so far, nowadays is I would say, even if it's controversial, the most promising business, because it's the one that is growing with the fastest pace. But back in time, this segment has always been.
Thank you very much.
We are ready.
Good afternoon. Thank you for having us. My name is David. I'm here with my colleagues Cedric, Michael, and Charles to give you investment advice on PKN Orlen, the Central European leader petrochemical company for both its downstream and retail segments. Orlen competes in over 6 countries, owning 6 refineries, capable of the highest production capacity in the region. The company also owns 2,800 petrol stations and employs over 20,000 people. This allows Orlen to secure strong financial revenues of 110 billion zlotys as of last year, an EBITDA of 9.7 billion, a return on equity of 16.2%, and a dividend yield of 2.8%. All of this while keeping debt under control. Orlen is partially owned by 2 financial institutions with minority stakes. The largest shareholder is the Polish State Treasury, and the remaining 58% are free float, amounting to a market cap of 44 billion. Other than the State Treasury, no other shareholder can have more than 10% voting rights, and this is to protect the company from a hostile acquisition from abroad. We identify 3 fundamental pillars that sustain the company's success, this being successful expansion, adaptive business model, and strategic acquisitions.
Historically, Orlen has been able to penetrate new geographies on an average of 4 years, currently considering to penetrate the Slovakian market for retail purposes. Moreover, it has been able to secure over 50 export markets over time. And this, combined with an ever-growing number of refineries, much larger than their most immediate and largest Polish competitor, has allowed them, in our forecast, to generate even higher downstream production volumes, for which we also assume a Brent crude oil price to stabilize from 2019 onwards at $66 per barrel. This, combined with a large increasing number of petrol stations, will amount to competitive advantages, namely having a global portfolio of infrastructure, being the biggest and the largest refiner in Central and Eastern Europe, and having the largest fuel stations network in Poland. This allows Orlen to have a sustainable, strong market positioning, being a Fortune 500 company. But Orlen has also an adaptive business model, making it able to swiftly react to changes in the environment. For instance, the growing regulatory changes, such as eco regulation, for which the IMO, the International Maritime Organization 2020 regulation, is the most important one. It aims at reducing the heavy fractions in the production of ships, for which we see that a Brent-Euro differential will increase. Orlen will respond to increase its medium distillates, such as diesel prices, to offset the price decreases in heavy fractions. But also there are consumption changes, for which we identify favorable macroeconomic changes, such as a strong growing GDP in Poland, a growing fuel consumption in Poland, and an ever-growing petrochemical demand over time, but also a growing importance of renewables in Europe over time. Thereto, Orlen is going to increase its retail focus to have growing retail revenues with stronger sales volumes per petrol station over time. It is also going to prepare itself for the green economy, making Orlen a more green company over time.
There is a very optimistic view on the macroeconomic level, both globally and the CE region. Therefore, the OECD and the International Energy Agency is forecasting the demand of the petrochemical to grow until 2050, therefore, and to reach half of the global oil demand. PKN Orlen is investing 8.3 billion Polish zloty within the next 3 years to have their biggest expansion in that matters, and also will be the biggest expansion of the petrochemicals across Europe so far. Moreover, in 2018, PKN Orlen signed a letter of intent with the Polish State Treasury to acquire Grupa Lotos. Grupa Lotos being the second major player on the Polish market, operating in 3 different countries, Poland, Lithuania, and Norway, with 5 extraction points. This will lead them to have the 3rd largest retail network in the Polish territory, with 6.5% of the market share, and their only refinery, located in Gdańsk, is known as the most complex refinery in Poland. Moreover, Grupa Lotos invested in the so-called EFRA project, which is the response to the IMO regulation. This will allow them to remove the heavy fractions entirely from the production and replace it with higher-end products such as diesel, which means that they will only have upside potential due to the eco-friendly regulations. We believe the merger to happen between 2019 and 2020, with the first payment in 2019 at 32.99% of the stakes. Another tender offer will be issued in 2020 to reach 66% of the shares. The transaction fully paid in cash is believed to reach 13.3 billion Polish zloty. Moreover, some significant synergies will of course be generated by both firms, starting to take effect in 2020 and reaching almost 900 million Polish zloty in 2025. This will of course have an effect on the earning per shares of the companies that will continue to grow at a pace at 5.3% every year.
For this merger, we identified two political risks, the first being the elections of 2019. However, we do not consider this to be a major threat for our case, given the fact that the merger will be too farly developed for the winning party to withdraw from the merger without causing economic damages. The second one is the European Commission, for which we identified the same thresholds that they will use to assess this merger. The first one is positive, given the fact that the post-merger market share in the retail segment will be below 40%. However, the second one is less positive. Therefore, we identify that fuel stations will have to be sold or swapped. However, even in the worst-case scenario, it will have a very minor effect on our future profitability.
Our three identified pillars of success will drive an important and rapid growth of revenues from 2019 onwards, which will then stabilize after the completion of the petrochemical development program in 2023. Those higher revenues, combined with an improvement of the profitability of the company, will ultimately result into higher EBITDA. This is made possible by the high capital expenditures of the company, mainly focusing on acquiring Grupa Lotos, increasing its petrochemical production volume, as well as focusing on the maintenance of fixed assets. For that reason, the company will have to increase its leverage up to 39% in 2020. However, as it will be able to generate higher cash flows from its operating activities, the company will deleverage from 2021 onwards. We can divide the free cash flow generation of the company into three different phases. The first one being the acquisition phase of Grupa Lotos, where revenues are to be offset by high capital expenditures. In the second phase, the company will benefit from the consolidation with Grupa Lotos, however, still having high capital expenditures for its increase in petrochemical development. In the third phase, the company will benefit from its increase in production volume of petrochemicals while having lower capital expenditures. Furthermore, we derive a WACC of ranging from 9.26% up to 9.55%, reflecting the change in debt structure of the company. Capital expenditures have been normalized, and this to offset the depreciation of fixed assets. And last but not least, the company will grow at a rate of 0.37% based on a return on invested capital of 10%. The company's strong performance will translate into an intrinsic value of 123 Polish zloty.
As for the relative valuation, we have selected a group of peers based on the distribution of revenues per segment. Then, using the PE ratio and the EV/EBITDA multiples, and applying them weights of 70 and 30%, we have reached a target price for the relative valuation of 107 zlotys, which was then given a weight of 20%, keeping the remaining 80% to the DCF method, leaving us with a final target price of 120 zlotys. This creates an upside potential of 16.17%, upon which we issue a buy recommendation. The two variables that can most affect our recommendation will be increases in the price of Brent and decreases on the differential. Our buy recommendation is valid as long as the price of Brent does not increase more than 26%, or the differential decrease more than 55%. Even when combining both of these variables, it would still be required a very large decrease on the differential in order for us to be put at the sell side. We do not believe this large drop on the differential to be likely to happen because of the impacts of the IMO 2020 regulations, which will create downward pressures on the price of Russian crude oil. For this reason, we are confident in our buy recommendation, and I would like to thank you for your attention.
Yes, definitely.
Question on valuation. You are calculating the Orlen price at 120 zloty, which is much above market value, and that's there is by recommendation from your side. So, in which area the market is on? What is the reason why the market is valuing the company business? What different than you? What is the main reason?
Yes, first of all, we believe that the merger will play the biggest part into this upside potential, as the market for now does not include fully all the effect of the merger, mainly due to the lack of information and also some uncertainty based on the European Commission and not going forward. But we do have strong belief that the merger will go through because we assess the same kind of assessment and analysis that used by the European Commission, and we do believe that there is no strong reason to stop this merger so far.
Why does this merger make sense?
This merger makes sense because it's economically driven. We do have some strong synergies created and will be created on 3 different segments, which is mostly on the cost side, and that will continue to grow until 2025 and reach almost 900 million Polish zloty per year. And second of all, it will also help us strengthen our position on the Polish market as well as expand more on the CE region.
Could you please, could you please say a word about the synergies, because it seems that you believe very much in them and you are not really telling what the synergies are.
We have divided them into 3 groups, one being distribution costs, because one of the competitive advantages of Orlen is their very effective network of logistical assets, and we believe that by integrating Lotos into that structure, that would lead to lower distribution costs for the merged company. Secondly, the other point would be lower cost of sales, meaning that the larger group would gain negotiation power and would be able to decrease the price they pay for their raw materials. And thirdly, we have deducted administrative costs because the headquarters would be centralized in Płock.
One more question on the valuation. The main reason of the, I would say, of your price is you are having different valuation of both methods, relative valuation and DCF. And at the same time, you have assumed a very high weight of DCF valuation. That's the main reason why the final price is so high. So why you put that much weight on the DCF, 80%?
Well, thank you for your question. We apply the weight of 80% on the intrinsic value of the company, as well as 20% on the relative valuation. Looking at the relative valuation, we see that the company will have large capital expenditures over the next 2 years, meaning that will be capitalized in the future, meaning that we will have a high enterprise value. However, the EBITDA in 2019 and 2020 will be only partially affected by the consolidation with Lotos. Because of the distortion effect of the acquisition with Grupa Lotos, we only applied a weight of 20% to this relative valuation method.
On the other side, for the DCF method at 80%, we do believe that it will take integration. It will take a full integration of the petrochemical program and all the synergies that will be created by the merger, and therefore it will be more relevant to apply more weights on this valuation.
What was your approach to value long-term oil reserves?
So for the oil price, we based on first of all on the big database that we have, such as Bloomberg and Reuters. However, we also took into consideration the macroeconomic situation based mostly on the OPEC and also on the Russian production that we have. Therefore, we derived all those assumptions to create Brent oil, which will be stabilized at 66%, and we decided to stay at a conservative position and also stabilize it on a very long term.
And if I may,
what is the value?
The value of
these reserves.
You mean the upstream reserves of crude and oil?
I am thinking about the oil reserves that the company has in the underground storage capacities.
Okay, well, in the strategy of the company, it is their plan to continue continuous and careful exploration of upstream. However, this is not a significant part of their operations, because it provides less than 1% of total revenues, and for which reason we have simply updated their current value applied with our forecasts of oil prices.
Did you add this value to DCF valuation?
This value is added in our model, which is a continuous growth of the upstream segment that is believed to reach 1,000 tons by 2023. But however, as a company is mostly focused on the downstream segment, it will not yet and did not announce any strategy to expand more on the upstream segment, which is the extraction that you're asking.
Two questions. One on the discounted cash flow method. If you go back to your slide, return on invested capital and long-term and WACC, you see, you can go back. You can see that in 2019 there was a higher return on invested capital versus WACC, and then in 2020, once the merger happens, the return on invested capital declines. I don't know, how does it, how do you explain that, the fact that you're saying that the merger will be value accretive? Mergers are usually complex and very risky. You can find research that says even 60% of mergers fail. So how do you factor in the risk of achieving synergies in your DCF model? Question one. And the second one, how in your relative valuation, how does the PKN compare to the peers, and how did you make adjustment for potential differences?
Well, sir, on the side of the return on investment capital, it is observed that in the past, the company had larger return on invested capital than in the forecasted period. So we believe that the return on invested capital is expected to reach a stable rate of 10%. However, on part of the merger, we still believe that because of the synergies and the stronger market position of the company, it will be able to sustain a better competitive positioning and to derive higher profitability.
Relative valuation?
Sorry, could you repeat the question of the relative valuation?
You came up with certain multiples based on your relative valuation. How does Orlen compare to the peers? And what adjustment have you made to the multiples, if any?
Well, we used for the relative valuation both ratios, PE multiple as well as EV/EBITDA multiple. And we assigned a weight of 70% to the EV/EBITDA multiple, as it is the best way to assess the company and the industry, which is highly capital intensive. Compared to its peers, we derived that the company has a higher EV/EBITDA ratio than its peers. And this is because we believe that the petrochemical development program, as well as the consolidation with Grupa Lotos, will drive a high enterprise value in the future. However, while comparing the EBITDA to this assessed enterprise value, the company has we derive a higher EV/EBITDA multiple compared to its peers.
You applied median multiple or median EBITDA or average, or what did you?
We used both PE multiple weighted at 30%, as well as EV/EBITDA preferred and weighted at 70%. We used the last 12 months, as well as 2-year forward multiple method.
For the peers, I believe your question is that we actually use the median of our peers, but to better represent how is the performance of the markets, and also the picking choice of the peers is we decided to choose our 7 peers based on their segmentation, because they have very close markets business model than us, with more focus on the downstream and the retail segment, and small parts, which is the upstream.
So you assume that basically Orlen is the same in terms of a risk-reward profile as as all of the other companies?
The really quick question. I compared revenues from Orlen itself and Orlen after. So the next group.
Thank you.
Na tym ekranie nie widać niestety.
Będzie. To
A na tym chyba nie widać. One, two.
Zasłaniać, wiesz? Musisz z tą stroną.
Good afternoon, ladies and gentlemen. My name is Michał, and today with my teammates, Tomek, Michał, Karolina, and Przemek, we are going to present you our recommendation of PKN Orlen, the leader of Central European oil and gas industry and the second biggest company on the Warsaw Stock Exchange.
We issue hold recommendation with target price of 106.51 Polish zlotych. The main drivers of our recommendation are sustainable financial situation, unclear future of oil industry, uncertainty about Lotos acquisition, and limited growth potential. We have to ask ourselves, how would the world look like in a few years? For sure, we'll have more cars, we'll travel more. The real question is whether oil would remain the major source of energy.
For the purpose of industry analysis, we identified certain global tendencies, namely strong economy and population growth, increase in vehicle stock, increase in demand for petrochemicals product, implication of IMO regulation, and new petrochemical investments leading to oversupply. These changes will cause increase in global oil demand by 5.7% until 2023.
When it comes to Europe, we recognize slowing down economy, negative implication of US-China trade war, and expensive naphtha feedstock for petrochemical production, resulting in decrease of oil demand in Europe by 1.4% until 2023. In case of Poland, we pointed out decreasing population, environmental restriction, as well as slowing down economy. We believe that those factors will allow Orlen to keep or even boost its profitability in the short term, but in the long run, the growth potential may be limited.
Orlen operates in 3 segments: upstream, downstream, and retail. Downstream is the most important for the company, representing over 65% of revenues. Moreover, Orlen is undisputable leader of Polish, Czech, and Baltic states wholesale market. Unfortunately, company utilizes almost 100% of its capacity and does not plan to expand it in the future. The only plan of developing downstream involves 8.3 billion Polish zlotych petrochemical investment. This is a potential growth opportunity as petrochemical division is characterized by higher product margin in comparison to refining segment.
We identify a positive effect of petrochemicals investment program only in short horizon, forecasting a spike in downstream margin in 2021. However, based on our research, this situation would not be sustained. Petrochemical margin will be declining in the long term. That is why we assume return of downstream margin to its historical average. As a result, downstream EBITDA growth rate will be limited.
The other important segment for the company is retail, which accounts for 34% of revenues. Orlen operates in Poland, Germany, Czech Republic, and Baltic states. Company has just announced entering the new Slovakian market and opening their 10 gas station. Moreover, Orlen plans to open 200 new fuel stations until 2023. On the Polish market, it has 34% of market share, which results in advantageous position.
In previous years, fuel sales per gas station was increasing significantly. However, if we will take into account current industry trends of refined product consumption, in following years, increase in fuel sales will not be so strong.
Orlen is also known for a wide offer of non-fuel products, the sales of which were increasing in previous years. Nevertheless, financial results from 2018 do not support this statement anymore, as we see significant decrease in this measure. We assume that the impact of non-trading Saturdays was opposite to expected. Thus, we anticipate that the future non-fuel sales will be recovering in line with Polish GDP growth rate. As a result, EBITDA growth in retail segment will be based mostly on gas station development.
When comparing Orlen to other companies, we used EBITDA per gas station, which is considered as the most comparable measure in the retail segment. Back in 2017, Orlen achieved 0.74 million Polish złotych EBITDA per gas station. Such a result did not surpass entities operating on the neighboring markets. Nevertheless, when it comes to the local markets, that level of earnings was 3 times bigger than the one achieved by Orlen's greatest competitor, Lotos, a Polish company located in Gdańsk.
Let's spend a minute on Lotos. It is important since currently Orlen is planning its acquisition to achieve full dominance on Polish market. Lotos is the second biggest player in Polish oil and gas industry with an annual capacity of 10.3 megatons of crude oil and 11.2% retail market share. Our team analyzed deeply impact of potential acquisition and synergies for both companies.
The aforementioned EBITDA per gas station is considered as the first area of improvement after Lotos acquisition. We believe that Lotos ratio will meet the Orlen one in the long run because of lower transportation costs and better product placement. Moreover, Orlen and Lotos as a one entity would have lower debt costs and better bargaining position to its suppliers because of bigger volume of feedstock orders. However, on the cost side, a reduction of workforce might be hard to implement as a consequence of labor union resistance.
Due to high uncertainty regarding the actual values of synergies, we decided to have a look at how the market priced them. For this, we checked how both of the companies reacted to the announcement of potential acquisition in comparison to the broad market index WIG. As a result, we came up with 1.1 billion additional value, which implies 600 million zloty EBIT annually to our DCF model.
After adding assessed EBIT synergies to Lotos DCF model and taking into account changes in financial structure of merged company, it implies that maximum price per Lotos share should not exceed 97.06 Polish złotych. Transaction value of 11.8 billion Polish złotych results in significant debt increase. Without Lotos acquisition, Orlen's net debt to EBITDA ratio is equal to 0.65. After acquisition, the ratio would increase to 2.14.
Let's move to actual Orlen valuation. In DCF, firstly, we modeled revenues, dividing them into operating segments, and allocated expenses by type, obtaining 8.4 billion Polish zloty EBITDA in 2019. In forecasted 5-year period, the average EBITDA would amount to 8.44%. Historically, this value was equal to 6.54%, which implies slightly lower performers in comparison to companies' rivals.
Moreover, Orlen has been generating positive cash flows except 2014. Even though the company's performance was negative, the main shareholder forced dividend payout. We expect positive cash flows and stable dividend of 3 zł per share in the following 3 years. After a period of intensive investments, we expect capex to be decreased in 2022 and thus dividend reach 5 zł per share in 2023. In the second part, we used appropriate WACC and growth rate to arrive at price of 107.54 Polish złotych per 1 Orlen's share.
Apart from our DCF model, we also conducted a relative valuation. We divided peers into 2 segments, refining and petrochemicals. In 2018, Orlen in refining segment is undervalued on P2E and EV to EBIT multiples and overvalued on EB to EBITDA. When it comes to petrochemicals, Orlen is undervalued on all multiples. Our analysis was based on the multiples between 2016 and 2020, and final price from this valuation is 105.47 zloty per share.
our research would not be complete without risk analysis. Besides market risks, we see significant impact of politics. Since control is held by state treasury, management board is changed as frequently as new government is elected. Additionally, company is exposed to be involved in political projects not related to the core business. For example, building nuclear energy plant. Also, dividend policy could be disturbed in case of exceeded budget demand for cash.
On the other hand, it might be actually an opportunity for the company that the main shareholder is so powerful. It might lead to higher entry barriers for new competitor, stronger negotiation position, or help in case of new strategic projects.
To stress our target price, we performed Monte Carlo simulation with certain market, operational and model factors. It was tested with 10,000 simulations to arrive at 31% probability of hold recommendation. One may ask, why is it hold, not buy or sell?
To make it clear, both valuation methodologies resulted in the range of the hold recommendation. The company has stable financial situation, satisfactory dividend payout, and strong position on Central European market. On the other hand, there are plenty of concerns, namely certainty of fuel consumption, limitations of petrochemicals margin, and Lotos acquisition price. This led us to issue hold recommendation.
Thank you.
Now thank you for your attention, and we are pleased to answer your questions.
I will ask the same questions as before. What are the main strengths and weaknesses of the company? Just a few points.
So the main strength is that the company is the owner of Supersite refinery, which has the highest throughput of oil among others competitors. The company is the leader of wholesale market in Poland, Baltic states, and Czech Republic.
When it comes to retail segment, we assume that Orlen gas stations are the most recognized in Poland, and they are the most frequently chosen by Polish society.
I think it's worth to mention the financial situation of the order, which is very stable. Company has sustained dividend yield and low debt.
So, any weaknesses?
Sure, I would like to go to weaknesses. For sure, in downstream segments, there is a significant weakness of refinery in Lithuania because of delivery of oil to that refinery. Orlen refinery in Lithuania is not connected through pipelines, so it might be a potentially and disadvantage for the company if they cannot deliver the oil there.
Okay, thank you.
In the strategy, the company assumes to develop the fertilizers business. And my question is whether you think it's a good direction, and in general, whether Anvil should be kept in the group in the future.
Sure, we think that petrochemical investment is great for this time, although in the long term, we assume that due to increasing supply going from US and Asia producers, petrochemical margin would not be so high. But in the following years, those products are the most profitable for the company, and we assumed in our model that after successful investment in petrochemicals, this margin would be bigger by $1.5 US per barrel, which implies over 1 billion to companies' EBITDA. So we think it's a good direction for now.
You assumed downstream EBITDA 2 percentage points CAGR, and you mentioned petrochemicals versus refinery. And my question is maybe could you elaborate a little bit more about the investment process and what kind of margin you expect from petrochemicals in it, like, and what will be the investment process versus the margin the company can extract from petrochemicals after the investment process?
Okay, so first of all, we modeled margin as a whole for the downstream. If we divide it to refinery and petrochemicals, it's like $6 per barrel in refinery and over 30 in petrochemicals. Combined result, it's $12 per barrel, and the average in previous years was $12.1 per barrel. We assume that after successful investment in petrochemicals, the petrochemical margin may stay at the same level as it is currently, but revenue structure and production structure in downstream would be shifted. Currently, it's 20% of petrochemical production in the whole structure. We assume that after this investment, it would be 25% in petrochemicals, which results in margin, total downstream margin growth to $13.5 per barrel.
How does Orlen compare to its peers in terms of revenue risk matrix?
Could you repeat the question?
You've done the comparable valuation, so you had to compare Orlen to the peers on number of areas. So how does it compare? What are the conclusions of this analysis, and how did it impact your peer valuation?
Okay, so we have 50% in our multiple valuation. We divided companies for refining segment and for petrochemicals. So the refining segment, mostly the companies from refining segment are in Europe mostly, only in Europe, sorry. And they have usually upstream and refining segment. And petrochemicals companies are global companies, yes. So they are all over the world.
Sorry, but how does Orlen compare to them? Is it more efficient, more profitable, less volatile, more volatile? And how did it impact your valuation?
Orlen is definitely less volatile than the peers compared to Europe. It's worth to mention that the Orlen is the leader of our region, so that's why he holds the position of the leader. That's why the margin is quite comparable to other companies, as it's shown now. So those are the refining peers in our region. But it's when it comes to petrochemicals, Orlen is below the companies that are worldwide, especially what we took to our petrochemical peers in valuation. So the companies from all over the world, especially Asia and United States.
What's your opinion on the current company's management?
Well, we think that there's very high rotation of the management in the company overall, but the CEO seems to be very experienced person. Since he used to be a chairman of supervisory board in Lotos, so in Lotos Biopaliwa, so it is a similar business. Furthermore, he used to be a CEO of an Energa company, so where he proved to be a successful leader, so it brings hope that he would be managing Orlen in a very good manner, and he knows business very well. When it comes to other executives, they seem to be very experienced people, and their work experience seems to be various, and they can complement each other to lead company to big goals.
And we need to remember that Orlen has very strong structure under the management board. In the previous years, management board have been changing many times, but the company was still profitable and was operating in a good manner.
Okay, so maybe one of the last one. Orlen is facing a very specific situation in terms of petrol. I mean, there will be soon a significant change in terms of cars. we can see it in other parts of Europe. When other countries, maybe not Poland, in most countries they are using much more hybrid cars or electric cars. So the question, I know it's not easy one, but have you assumed in any way that the need for strategic change of Orlen, and was it included in any way in expenditures?
Well, so according OPEC's report on the future of fuels, crude oil, they assumed that in 2017 there was around 1.1 billion vehicles in the world, and up to 2040, the number would increase to 2.4 billion, of which only 320 million would be electric cars, which is around 0.13 of the total vehicle fleet. So it does not pose such high risk to the entire market and to our company specifically. So we assume that the whole change in the road transportation would take a lot of time, and currently company is safe and it doesn't pose such a huge risk to our operations.
For sure, we see the change in behavior of people, and they choose hybrids, as you said. And Orlen is currently switching to this new strategy, and they announced this month or last month.
Recently.
Yeah, recently, that they are opening first 50 chargers. Thank you.
Gdzie był? Dobrze, ja zostawię.
Okay, thank you. Okay, yeah, this is ours. Okay. Well, cool. So, are we ready?
Okay.
Start. Good afternoon, ladies and gentlemen. During next 10 minutes, you will be watching our presentation, and meanwhile, Orlen will earn approximately 2 million zlotys. That's why Timo is here to present you a recommendation for PKN Orlen shares, the firm that you must have in your portfolio. Let me first discover the presentation structure and our team. I'm Władysław, and I will be talking about recommendation, company overview, and first part of industry. Karolina will take another part of industry. Financials are divided between Ania and Angelika, and Karolina will provide more details about valuation. Due to the research we have conducted, we issue a buy recommendation for PKN Orlen share with target price of 122.4 zlotys in 1 year horizon, which means 18.5% upside from 8th February price. Foundation for analysis were both discounted cash flow method and market multiples, which were given the equal weights. Let's now move on to short business description. A leader in retail petrol sales in Central Europe, the biggest Polish oil and gas sector player, a second largest company on Warsaw Stock Exchange by capitalization. All this refers to Orlen. The company has more than 70 years of experience in oil and gas industry. Activities and operations are divided into 4 main segments: downstream, upstream, retail, and corporate functions. The company is present in Canada, and Orlen also benefits from CE being a demanded region for petrochemical products. Almost 2,800 fuel sites provided a strong retail market position in Central Europe. Defining the main macro parameters is very crucial for the company that have so complicated relations between earnings and geopolitics. Key market indicators are exchange rates, oil prices, and margins. So all volatility of the market will impact both positively and negatively on Orlen and on also other companies from oil and gas sector. So if it comes to margins, it depends on oil prices. So the higher prices, the lower margins, and vice versa. So the higher margins is more favorable for the company's financial situation.
As an estimation of currency trend in long term is impossible, we decided to set our assumption on a spot level. Orlen receives some parts of its revenue in foreign currencies and in the same time buys raw materials for production in dollars and euros. And this situation may be considered as some way of a natural hedging. In a matter of Brent crude oil price, in a long term, high price is not a good situation for a retail segment, because while in a short term, demand for fuels is not flexible, then in the long term, people are starting to search new alternatives for these fuels, and in the long term, demand for gasoline and diesel starts to be more flexible.
All great investments involve some risks. We conduct our research on PKN challenging position when it comes to their financials activity, industry, and market position. During process of creation of valuation, we analyze the possible impact and likelihood of these risks. Market risk has the highest impact on the company, such as Regulation IMO 2020. That regulation will increase demand on middle distillates, such as diesel oil, while demand on HSVO might be lower. Sustained high margin pressure. Petrochemical margins are strongly correlated to the oil price. Therefore, rising price of oil may affect the PKN. Changes in oil crude prices and refining prices may cause significant cost for the company. Risk related to CO2 emission prices and modernization of refining have lower impact, while costs implemented by synergies of further acquisition, political risks and exchange rate changes, and also the risk of entering the new businesses have lower likelihood. Financial risks such as credit risk and liquidity risk are negotiable. Competitors. We analyze the publicly traded companies of a region with similar business profile as Orlen. We analyze their market share in petrochemical products in domestic markets, all above 50% for PKN, the total debt to EV and total debt to equity. Also the quantity of station network in Poland. Orlen has unwavering retail leader position in the Central Europe region and has lower debt than others.
For a better understanding and assessment company's financial situation, let's take a look on key financials data. First of all, PKN Orlen achieves record results systematically in downstream and in retail segment. Secondly, on a basis of management assumption, we assume financial leverage will be maintained below 30%. And last but not least, we can see constant growth of dividend per share. In our forecast, dividend doesn't drop below 3 zlotych per share. Moody's Investor Service has upgraded PKN Orlen's rating to Baa2. This upgrade reflects company's efforts to reduce its debt and keep all financial ratios at safe levels. PKN Orlen's financial positions is stable, with cash flows and available financing sources sufficient to implement investment plans. Each year, main part of CapEx is allocated to downstream segment, with particular attention to petrochemicals and refinery development. CapEx budget for 2019-2020 will average 6.8 billion zlotych, whereby almost 5 billion zlotych will be allocated in downstream.
Our first valuation method is a comparable companies analysis. Chosen peers have a similar revenue structure as Orlen. This means that majority of revenue have to be generated by downstream segment, and upstream stake in revenue cannot be significant. We analyzed EV/EBITDA and PE ratios since 2013. Moreover, team also estimated this ratio for the next 2 years. An implied share price from CCA valuation is at the level of 122.87 zlotys. To a DCF, which is our second valuation method, we estimate company's revenue for the next 5 years. And after that, the perpetual growth factor was set at the level of 0.5%. The weighted average cost of capital, calculated on basics of our assumption, is at the level of 7.51%. Each segment of the operating activity was analyzed separately. The biggest part is downstream, and to the estimate downstream revenue, we used our forecasted margins. Retail segment revenue and corporate functions costs were estimated by conducted linear regression models. And in the retail segment, our revenue are explained by 4 factors, which are gasoline price, diesel price, number of stations in Poland, and total number of cars in Poland. Corporate functions costs are dependent on the development of other Orlen segments. Last part of analysis was upstream segment. And to estimate upstream revenue, we rely on official Orlen statement about its future extraction of crude oil and gas. Implied share price from DCF valuation is at the level of 121.94 zlotys.
By issuing a buy recommendation, we are deeply sure in following statements. Namely, Orlen indeed is unquestionable retail market leader, and stable dividend policy is showing off a good and solid financial position, and company becoming more and more.
Thank you very much.
Thank you.
You're ready for questions? Jury's ready for questions?
Yeah, we are ready.
Okay, start.
You estimated 20% upside, if I'm not wrong.
18.5%.
What are the main risk factors here?
So when it comes to revenues, it will be a lowering demand on SFO and the different than we assumed implementation of IMO and the increasing demand on diesel oil, which by OPEC was prognosed being twicely upgraded to 1.6 million barrels per day. Also from market risk, it may be CO2 emission prices changes, but as the company claims they are using hedging instruments on this, and
their risk management policy is effective on this kind of risks?
All valuation can be affected of, for example, commodities prices, for example, of oil prices, and as I said, margins and other macro factors.
And Orlen Lotos merger, provided it happens, what are the pros and cons for Orlen?
So, as the European Commission statement, the allowance was not given yet to the Orlen. We assume it's too early to implicate this in our valuation. The price parity is not published yet. That's why we didn't calculate the cost of synergies. But if the takeover will affect, it will upgraded capex on Orlen, but also later optimize operational costs and lower competition in the region.
So mainly, we can't include it in our valuation because, as my teammate said, this is too early to.
Right, but provided it happens, it happens, what are the key pros, like the number of gas, taking into consideration the number of gas stations, the breakdown of downstream, upstream, retail. So where do you see potential pros, and on the other hand, cons? Just two for each, two pros, two cons.
Pros in lowering operational costs, lowering competition in region, and optimize costs in all.
So mainly, if it comes to this merger, to this acquisition, the first it will be being a market leader, and this is a process. Pros and cons is that, for example, it will the capex will increase, and synergy cost can be lower than capex, so it can be, for example, profitable.
Yes, then we're seeing a potential in increasing percentage of upstream activity to optimize costs in wholesale.
And Orlen also can be a monopolist in inverted commas in Poland. So this is the main cons.
Yes, and then further extension for other countries.
In your DCF model, you are assuming capex significantly higher than depreciation in the forecast period and then in the residual period. Why is that?
We assumed capex on basis of Orlen official statements, and it was said that it will be above 5 billion zlotys, and we decided that in next years capex will be constantly increasing.
So firstly, we assume that capex will be in 2019 and 2020 at level of on average 6.8 billion zlotys, and next we just projected this capex because we think that firm won't be rejecting any other opportunities to extend.
Okay, then in that context, please justify your perpetual growth rate of 0.5%. We're spending a lot of money on capex, yet we don't see it in the growth.
Yes, but Orlen needs high capex for its research and development projects. But in the same time, it's already a big company and monopolist in Poland, and the growth opportunities aren't as big as for other, maybe smaller companies. So we decide that 0.5% is adequate value, but we also analyze sensitivity of DCF price for changes in perpetual growth factor. And even if perpetual growth factor was below zero, when it was 1% below zero, the price from DCF was still in a buy recommendation.
My question is whether you use WACC or cost of equity to discount your cash flow. I'm looking at your DCF model.
Okay, so our main assumptions for weighted average cost of capital to the
question is whether you use WACC or cost of equity in discounting process.
We were using WACC in discounting.
Okay, I'm asking because you are calculating free cash flow to equity, not free cash flow to firm. So according to the methodology, it should be discounted by using using cost of equity.
Yeah, we discounted all cash flow using a WACC parameter.
One more question. You are having the price which you provided is much higher than the market. So in which areas you are more optimistic than the market? Is it the margins, revenues, or discount rate?
I suppose that we aren't too optimistic in any of our assumptions because our assumptions according to currency trends or oil price are quite conservative.
So we also assumed a conservative strategy for evaluation, and it is shown, for example, on this industry slide and about, for example, Brent oil crude prices. We also assumed all data from IAA agency. And also they are providing information forecast for Brent crude oil and another, for example, ORB price, and this is at the level that we have. So we didn't calculate another data, just use the data that all energy agencies are providing.
Regarding the multiple valuation, it seems that you've chosen, I think it was 8 or 10 companies where one of them was, it was one Hungarian, one Italian, and then a Finnish, then 2 Greek, 1 Israel, 2 American. How would you justify this choice and having actually so few companies from the region?
Our choice for comparable companies analysis, generally our main criterion was revenue structure. We search companies which revenue are generated mostly in downstream segment and that upstream segment cannot be significant in revenue. And our other choice condition was that this company have to be profitable in last 5 years. We analyzed average profitability ratios such as return of equity, return of assets, and return of sales. And each of these companies have a positive 5-year average ratio.
Don't you think it generates kind of a bias in valuation if you're doing such a selection of pure companies and then you are comparing the company you're evaluating to the peers that you have just selected basing on their financial results?
That's why we assume that this comparable company analysis has also from
Literka V jest teraz. Nie, sure.
Good afternoon, and thank you for your attendance. We would like to present a financial report about PKN Orlen S.A. We issue a buy recommendation with a target price 128.98 zł. The upside above 90% will be a consequence with the remarkable financial performance, dividend policy, and some actions related to the company, which will be discussed later. The story of the PKN Orlen begins in 40s of the 20th century. Since then, and despite turbulent times in Poland, today is one of the greatest oil refiner in Eastern and Central and Eastern Europe. It is on stock exchange since 1999. It has 3 operational segments and produces above 50 types of extra quality refinery and petrochemical products and sells it to the stakeholders scattered around the world. Moreover, the company every year wins awards concerning CSR. Most of revenues come from Poland, then Germany, with Czech Republic and Baltic countries. Downstream has 64% into revenues, in total revenues, before retail with 34%. The company has significant position in downstream fuel market share. In countries listed on the slide. Also, share in Polish retail market is share in Polish retail market is also share in Polish retail market is almost 35% and stays on a moderate level in Czech Republic. Lotos acquisition will be a chance to increase a position in the downstream fuel market in Europe. Moreover, the company is constantly pays dividends since 2012. For 2017, paid 3 zł per share. It is state-owned.
Currently, among all energy sources, the most energy obtained from primary energy consumption comes from crude oil. In 2017, oil consumption contributed to more than 34% of global energy production. Prognosis for years from 2015 to 2020 indicates oil and gas as 2 fuel types with highest demand growth level, which will have been grown by 2020 by 7 million BOE per day for both oil and gas. From 2020 to 2030, all demand growth level will decrease to 5.5 million BOE per day, but it still be growing. Over 30% of global oil production comes from OPEC countries, whereas EU countries account for less than 2% of it. That implies EU oil demand relies highly on OPEC, extraction and supply, which can lead to oil price steering abuses and for political purposes. There are 4 main groups of oil price determinants. It is demand, supply,
USD exchange rates and speculation. For first two groups, it is economic and population growth, new extraction technologies, or OPEC strategy, or environmental trends. Refineries in Europe are located in the central west side, which means there's a higher competitiveness level in companies in Western Europe than it is in Eastern Europe. Oil industry contributes to oil industry is marked by high level of competitiveness and bargaining power of suppliers.
The main driver of volatility of Orlen's revenues is the oil price change with the correlation coefficient at 88%. In 2017, revenues reached over 95 billion Polish zloty with year-to-year increase of over 19%. In 2018, debt-to-equity ratio was at the level of 30%, and the debt value was 9.6 billion Polish zloty. Most of that debt comes from bonds. 65% of cost of goods sold comes from the materials and energy needed in refinery and petrochemical processing. 23% comes from the merchandise and raw materials, as Orlen also operates in the retail market. The average EBITDA margin of Orlen during the past 5 years was at the level of 6% and was 8 percentage points lower than the industry. However, the biggest negative impact on that has been due to the operation loss in 2014. Orlen's liabilities are mostly the current ones, forcing company to maintain a lot of non-fixed assets during the year, while asset management ratios fluctuate mainly depending on fuel prices. Between 2015 and 2017, return on equity reached over increased by 8 percentage points to over 22%, because of mostly the oil prices going down. We estimate that in 2018, the return on equity will go back down to 14%, with sustaining that trend in the following years.
Let's get into the valuation part of our presentation. In order to estimate Petrochemical share price, we combined DCF model with 67% weight and peer group valuation with EV/EBITDA multiple with 31% weight. In our DCF model, we use regression analysis, tying up revenues and COGS per ton sold with oil prices. Then, by taking oil prices from the future market, we're able to estimate sales and costs for the next 5 years. We also believe that volume sold of PK and Orlen will grow in the future at the rate of GDP growth of countries in the Central Europe. CapEx was taken from company strategy to 2020, and after this period, it will grow at an inflation rate. For Lotos acquisition, we assume that it will happen in third quarter of 2019, when PK and Orlen buys 33% shares of Lotos for 4.5 billion zlotys. Apart from 5-year prognosis, we also added residual value calculated with H model. For WACC, we use cost of equity estimation. We use CFA model and taken company bond yield as a cost of debt. After all of that, we were able to get a final value of 146.71 zlotys and prepare a sensitivity analysis using Monte Carlo method with 78.04% observation higher than the market price. For peer group valuation, we have chosen 5 companies with downstream orientation and operating in the European market as the main requirements. Also, 2 of these companies are state-owned. We used historical values of EBITDA from the last 5 years and prepared a regression analysis to forecast its value for 2018. We assumed that EV/EBITDA for 2018 for PKN Orlen will equal to median of its peers and got 4.17 as a multiple. The last part was taking this 4.70 multiple, EBITDA and net debt to get a total equity value of 40 billion zlotys, which makes share price at 93.52 zlotys and 128.98 zlotys when combining with the CF approach.
We identified the main risks of the company and visualize this using the risk matrix. Thank you very much.
So time starts.
On one of the slides that you have described, there is a DCF model, final price, and I'm having a question to this slide. You have calculated the final value as of 146.47 almost zloty, and that value was taken into the further analysis and which you made earlier. How did you? What is the relation between median price, average price, which is 125, and why you took 147 for the further calculation? Because 147 is on your right side, to be honest. Yeah. So what could be the reason of such a situation?
Okay, the DCF model, the final value of 146 zloty was calculated with futures contract for crude oil, and the median price of this 225 in the Monte Carlo calculation was with using the historical data of crude oil, yearly crude oil from the past 10 years. So this is why this change is bigger than it should be, is that big. Because the futures are mostly constant or slightly differ in another periods, but historical data was like in 2013 prices were much bigger than, for example, 2 years ago.
Okay, so maybe additional question to my first one. Why the market price is in such a situation so low? Because the market is around 105, 6, 7, and the value which you calculated is 40% above. It means that the assumptions which you assumed or the discount rates are much different to the market assumptions. So if you could elaborate on this a bit.
I think it's mainly due to current weaknesses of Polish stock exchange. First, there's declining number of IPOs. Polish indexes like WIG and WIG20 are underperforming S&P 500, for example. And like asset management fees in mutual funds are way higher than the European average, and that's why I think the Polish stock market is weak at the moment, and that's why I think we can get a company with an intrinsic value much higher than the current price.
Okay, in terms of revenues. In a DCF horizon, when it comes to breakdown on the revenues from downstream retail and upstream, do you see any changes throughout the horizon? And did you estimate what kind of changes, or if any, you estimate in terms of breakdown?
So the revenues of the downstream mostly consist of mostly depend on the crude oil price, but we assume also that the retail the sector of retail will go higher than the oil prices, because we assumed that the retail will go with a linear trend using the linear regression, and the revenues from downstream will go with the volume change. What volume change is depending on the real
GDP growth. And the other thing is acquisition of Lotos. Lotos is more upstream oriented than Orlen, and that will mean that this company, after this acquisition, will have more upstream share than it currently has.
Did you take into consideration the merger with Lotos, this valuation? No.
Yeah.
Okay. Do you see any changes in breakdown in terms of downstream, refining versus petrochemical? What kind of assumptions you got?
I mean, we didn't make any changes in that.
So again, how did you factor in Lotos acquisition?
Okay, so in the third quarter of 2018, Orlen will buy 33%, 32 to be exact, 32.99% of Lotos shares. And from that point, we added 33% of Lotos FCFFs from its valuation to DCF of Beck and Orlen.
Synergies?
We can see some synergies. First of all, better prices from the suppliers and all that, but we don't think that will be that significant.
They have the same owner, so the synergies, we assume that synergies will be irrelevant in this case.
Why did Orlen have lower profitability than its peers in the past?
There might be numerous of reasons. For example, the bargaining power of suppliers, or the transportation cost, or maybe even the structure of because of the treasury having the shares in Orlen. That's because maybe there might be some lower margins because of the not wanting to prices being much higher than the oil price at the moment.
We are observing increasing role of alternative fuels. How this trend can influence the value of the company?
Okay, so the renewables have will grow by more than 8 million BOE per day, but in 2030 to 2040. So it is actually in our residual value, and because there's a value over time effect, so it will have a very small effect on our valuation and our valuation result.
I think in short distance it won't, and it doesn't matter, but in the long distance, but our assumptions weren't by these weren't done by the period of the more than 5 years. So we assume that it's not changed that much of revenues.
Yeah, we used H model for evaluating residual value with the higher growth rate of 2.5%. That will go down over 5 years to 1%, and this is caused by shift towards more renewables. And 2.5% growth rate is not sustainable in the long run for an oil company.
So you assume that they will acquire or they will merge with Lotus?
What will be your recommendation if this doesn't happen? If the European Union doesn't sign off on it?
Actually, I think that basically when we try to evaluate this deal, we use the lower rate than usual. We use 30%, more than 30% of the deal. So we look not too optimistic in the deal. So it's already raised the chance that the European fund not side on that. So we already take it into account.
Thank you very much.
Thank you very much.
Yeah.
Very soon.
Not touch.
Okay.
When you're ready, just tell. Just relax. When you're ready, just tell.
It is terrible. Claudia, you have pilot?
Yes.
Yeah, we are ready. So, good afternoon, ladies and gentlemen. We are Team R, and today we would like to present you our analysis and recommendation on PKN Orlen, the biggest Polish oil and gas company. We issue a sell recommendation with a 12 months target price 88.99 PLN, which represents almost 14% downside potential. Our recommendation is based on 5 main pillars. Firstly, pressure on the refining margin, increasing competition in petrochemical segment, doubtful Lotus acquisition, strategy exposed to political influence, and the termination of friendly market trends. Now, to better understand the segments in which company operates, we explain each business unit's divisions. Firstly, upstream. Company has upstream activities in 2 countries, in Poland and Canada. PKN extracts both oil and gas, but Orlen doesn't process its own oil. The main business segment, downstream, consists from 3 main business divisions. Refining division, PKN manages the biggest Polish refinery. Petrochemical division, Orlen is a main supplier of polymers and monomers in Poland, and the power generation division. PKN has a capacity to be the 5th largest energy producer in our country. The crude oil processed in company refinery covers a significant part of its petrol stations' demand. Now, we slightly move like a tank truck to the retail segment. Company has a retail sites in 4 Central European countries. In recent years, this was the segment with the fastest growing revenue, but we expect termination of this trend.
So let's take a look on the market analysis. The upstream sector is strongly regulated and mostly dominated by state-owned companies, which often achieve a monopoly position in their region. The competitive position is strongly related to the place of the extraction. The market is very liquid and depends on many economic and political factors. Because the sea region is poor in oil and gas resources, the companies operating in this region are forced to import much of these raw materials from Russia. The refining industry will steadily grow in the coming years. However, the refining margins are exposed to a decline due to expected increase in the oil prices. In addition, in 2020, the IMO agreement will enter into force, which will limit the demand on high sulfur fuel oil to which PKN Orlen's refineries are adapted to produce. The petrochemical market is under the pressure of increased competition due to companies operating in the United States and Asia. Additionally, the Polish market will experience the oversupply of propylene due to investments carried out by PKN Orlen and Grupa Azoty. The retail market is very saturated, and it is expected that will slow down in the coming years. In 2016, there was a legislative change which limits the gray zone, which contributed in the increase of the number of independent distributors. The PKN Orlen is the leader of the Polish market and is also developing its businesses in the Germany, Lithuania, the Czech Republic, and also in Slovakia from this merge.
Now, as we know something about the business and the market, I would like to show you how these two merge in PKN financials. Firstly, EBITDA LIFO. Important because it excludes the impact of changing crude oil prices on the inventory valuation. But as investors, why do we care? Well, the EBITDA LIFO moved just like PKN share price. Moving to macroeconomic factors. First, crude oil prices. As the downstream sector stands for 65% of PKN revenues, growing crude oil prices, highly visible in 2018, may have a strong negative impact on the results. Second, fuel consumption. Management talks big about the growth of retail segment. Well, comparing the growth of fuel consumption in Germany and Poland, it's obvious. However, having in mind that it mainly comes from counteracting shadow economy program, we expect this trend to slow down. Going through segments. Firstly, downstream. With continuous growth of revenue, is noting a significant drop of margins. Retail grows, but with the lowest margins in the group. Upstream, well, the revenue is marginal, and due to that, DNA causes the huge difference between margins. Analyzing CapEx, we can observe a huge disproportion in the upstream sector between the scale of business and the expenditures. Assuming lack of any cost optimization for the group, we see this segment as a source of cost without an adequate result. Looking in the future, between 2019 and 2021, we expect the profit on sales to drop on the downstream sector and to slow down on retail. Comparing PKN to its peers, well, it doesn't look that good. We can see the impact of macro factors in the whole group. However, EBITDA margin of PKN Orlen is rather low and still dropping. Analyzing liquidity, PKN stands on top of the group with the lowest ratios, however, is definitely not leading with a cash conversion cycle of 31 days.
Starting with DCF, we applied a model with a 14 years forecast period. Considered length of the investment projects, high expansion capex in first years, and transition to residual growth. Our G at the level of 1% is beyond the inflation target, but above analysts' consensus. Our WACC of level of 8.7% was calculated based on cost of equity based on betas of comparable companies. Orlen's free cash flow to firm falls in the year 2021 because of the very high growth capex due to assumed delays in the investment projects. Because of our length of our forecast period, the discounted residual value accounts for only 40% of the enterprise value. In our Monte Carlo analysis, we've assumed a log normal distribution for crude oil prices. We've assumed this type of distribution as atypical for commodities and achieved a 73% confidence level in our SER recommendation. In the sum of the parts multiples analysis, we found 6 comparable companies for each of the segments. Retail is the most valuable one because of the highest EV/EBITDA multiple of 7.3. Based on our company as a whole multiple valuation, our share price is 82.3 PLN. Having our free valuation approaches and wages of 50% for DCF and 25% for each of the multiple valuation, we've achieved a 12-month target price of 88.99 PLN per share, resulting in a 13.85% downside potential.
Looking at Orlen's operations and historical stock prices, we can clearly see how cyclical the refining business is. Apart from the high systematic risk, we have also identified primary operational risk factors. Petrochemical business, which accounts for 28% of the company's EBITDA, might be under pressure because of lower gas prices and lax environmental regulations in Asia and America. An additional risk is connected with the shareholder structure. As a company controlled by Polish government, PKN and Orlen might be involved in dubious investments as a nuclear power plant. Such an investment would be associated with a negative NPV and many years without dividends. We are also concerned about frequent changes in the management board, which led to inconsistent investment policies and not being ready for IMO regulations. In February 2018, Orlen has signed a letter of intent to take over its biggest competitor, Lotos. In our opinion, the merger has some business logic. However, after a 70% growth of Lotos stock price, it is definitely not the best time for the acquisition. Moreover, the potential cost synergies might be limited due to labor unions and political reasons. The refining environment over the past few years has been extraordinarily good for European downstream companies. Because of a new refining capacity, we expect lower utilization and margins in the following years.
We could say something more, but the bar is already empty. Thank you for your time and attention, and we're looking forward to your questions.
You ready for questions?
Yeah.
Yes.
So maybe let's start from Lotos and Orlen merger. What's your more detailed view on that, and how would you see the value creation or value destruction on that?
In our report, we assume the potential synergies at 600 million annually for combined companies. Using the average weighted multiple for both companies, it gives us additional 3.5 billion value after the merger. The main drivers of synergies are connected with streamline of transport and logistics, also higher bargaining power and potential administrative cuts. However, administrative cuts could have been surely bigger in the combined company decide to move the headquarters of Lotos from Gdańsk to Warsaw. We think that this is highly unlikely. In the day of announcement of the acquisition, both companies rise over 5%, what shows that market was happy, was satisfied with the decision. However, in February 2018, the situation was totally different. Lotos was trading at 55 zlotys per share, and at the moment, as we can see everywhere here, is trading at 96 zlotys. The situation is totally different, and we also think that the majority of the growth of Lotos stock price is due to assumed merger, which would be surely beneficial for all Lotos shareholders.
Why do you think the price is, in comparison with your valuation, the market price is so high? In which areas do you see the market is overvaluating your analysis?
So probably the biggest factor is that market does not see all potential risks which are connected with Orlen. We know many companies which also have a strong political influence on the Polish stock market, as energy companies, Energa, PGE, and Tauron, for example, which are trading at lower multiples, which are around 3-4 EV/EBITDA multiple. At the moment, Orlen is trading with a premium, which is around 25% in comparison to its regional peers, and actually, because of heavy exposure on HSFO, we don't see that such a premium at the moment is justified by updated technology or a strategic geographical position.
In your comparative valuation, you've it's very conveniently on the page here. You've looked at number of peers. How does Orlen compare to them with respect to profitability, risk, growth, and how did you factor that into your valuation?
I think that it was the correct slide.
Correct slide, yes.
Could you come back to the previous slide?
Okay. The previous slide, okay.
Yeah, from one side we see a companies like which have an outdated technology like Hellenic Petroleum or Saras or the Tuplas, which trade at lower multiples due to some technical problems. From the other side, we see companies like Neste, which are traded at Finnish stock market. This company is maybe not totally different, but significantly different from other peers because of heavy exposure on eco-friendly solutions as eco-fuels and so on. We think that these are the factors which differentiate the multiples for those companies, and we also think that Orlen is somewhere in the middle. Orlen is heavily exposed on downstream sector, as those companies are. So we think that these are good multiples, which somehow show the potential risks connected with the downstream.
But the range of
sector.
multiples is huge, from 2.4 to 13.5.
Yeah, it is big, mostly because of the Neste, which business is a bit different than the other companies. But what we focus the most is to choose a companies which focus mostly on downstream. We didn't want to take peers which have a strong upstream sector. That's why we have chosen those companies.
And maybe, continuing with downstream, the company is investing heavily in downstream, in switch to petrochemicals. And do you see what influence you see in your forecast, if any, of that? Revenues especially, because costs are...
So, firstly, we've assumed those capex in the petrochemicals. Right now, the company invest in the metathesis and will have additional capacity of 10,000 tons of propylene each year. But due to investment of Grupa Azoty and its new capacity of 400,000 tons of propylene each year, we think that there will be an oversupply on the Polish market of propylene because right now the Polish market imports only 150,000 million tons of propylene each year.
What do you think about upstream strategy of the company?
First of all, we think that the capex on the upstream segment of Orlen is too high comparing to the EBITDA and the inflows from this segment. And additionally, the very big disadvantage of investing in upstream is due to Orlen invest mainly in Canada and cannot take those products in their downstream segment.
Yeah, and here you can see the forecast on 2019. You can see the white part, it's upstream. And what we said, this is a huge disproportion. Mainly, disproportion between the scale, between the revenue, considering the lack of cost optimization because of the upstream is mainly in Canada.
Yeah. To add on, we know that Orlen was trying to somehow hedge the oil risk connected with huge changes in oil pricing, in oil prices by investing in upstream. But we think that because this segment is so small, it does not give any additional any hedge effect. And from the other side, Orlen has to have bigger administrative costs because of managing this sector in Canada.
Well, Chris, can I add something? Chris, could you switch for the pipeline map? And for the upstream segment, it's also very important thing that the Orlen has a huge benefit from the continental premium due to pipelines. And the upstream in Canada, in comparison to these pipelines, is totally irrelevant.
Could you comment on the changes in EBITDA margin 2014 to 16, 18?
Financial. This one?
The next one.
The next one.
Yeah. Yes. Yeah.
Comment and explain to us what drove EBITDA changes.
Okay, you can start.
So, as we said before, Orlen is strongly valuable at oil price changes. And we did a regression based on the last 15 years, and we can see that the higher the oil price, the lower the EBITDA of Orlen, and the lower the stock price of Orlen. The Orlen's results are mainly driven by downstream margin. And the margin is mostly based on the crude oil price. The other factor is growth of retail sector, which is dynamically growing from the last 10 years, especially in the last two, what was connected with dealing with a gray zone and Sunday ban in Poland. But those factors are temporary.
Thank you very much.
Thank you very much.
Thank you.
So that concludes our competition. Now we need probably some minutes for the summarizing results. So teams can come back here, and then jury and myself will go to another room as usually, and then we'll count the points. invite Dagmara and also Michał to the stage just for the giving awards, let's say. I have to tell you that, as you know, the first two teams go for the Zurich, for the EMEA final, which is then since 11th of April. Then the three first teams will receive the scholarship, CFA scholarships, given that the members of team register for the exam, of course, right? So, and then we automatically assign the CFA scholarships for those members of the team who decide to participate in 2020 actually exam. Well, yes, 2019 is too late because scholarships were given last year. Also, the winning team, also these three first teams, they will receive internships in Deloitte, internships in BGK, in Bank Gospodarstwa Krajowego, and internships in Orlen. And finally, the winning team also get free participation in European Investment Conference in Budapest, which is regional conference. And also Deloitte kindly decided to fund this award, simply. Now we go with the presentation starting from, all teams were excellent. So even if somebody has to be in the 7th place, somebody has to be in the 1st place, of course. But you were very good, and you competed with other 19 teams, because there were 26. So we already get big success getting to this final. And I'm going to start from the place number 7. And I would like to come here to the podium. Place number 7 is Poznań University of Economics. Good applause. Tak. Nie każdy potrzebiesz, to tylko to. Nie tak. Okay? Maybe I ask you also come. So, congratulations. 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 All the best. At the very end, we will have the photo of all teams. Team number 6. This is a historical moment because we have team from abroad. ISM Vilnius, team number 6. Is the Vilnius here? Oh yeah, they're coming. This year we have several teams from Lithuania and Latvia, and they are the best. Thank you very much for coming, and this comes like small regional competition already. Congratulations. Also to your mentors. Congratulations. Congratulations. Yeah, thank you. Team number 5, position number 5 is Krakow University of Economics. Congratulations. 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 Now it's position number 4. It's Kozminski team GC. Congratulations. Congratulations. Teraz to wręczamy. Ale nie, to teraz wręczamy. Trzecie, drugie, pierwsze. Czyli teraz wręczamy, tak? Okay, now we are coming to the bronze medal, silver medal, and gold medal. So we go from the 3rd place. At the third place is Kozminski CDMC. Congratulations. There is also this stuff, plus all these others. I would like to ask Team 3 stay at the podium because we will have the medalist picture and also at the very end we will have picture of all teams. But now the podium. Position number 2 is Warsaw School of Economics. Sorry. Czemu tu są dwa? Okay. And the final first position is Wrocław University of Economics. Congratulations.
Nice one. Well done, guys. Good job. Very well done. Really. Very well done, guys. Congrats. Congrats. Good luck in Zurich.
So the photo for...
Maybe stand closer to each other. Yeah.
Okay, and the last moment, photo of all 7 teams. So please stay on the stage. And please, teams from the positions from 4 to 7, please come. And I have to, so please come to the stage. And all the people who are invited, 200 meters from here, there's Misha 2, I think is Misha 2. There is a very nice place, and we can also acknowledge mentors, graders, panelists, etc., etc.
And then it was good, bro.
Zamówić Halo? Zapraszam tutaj. Tak?
No, it's okay.
Zapraszamy za mównicę. O, właśnie.
Now, yes.
So,
now we are the most
all of
serious
the Koźmiński University students, we know that it was very good performance of our team, and I would like to invite all of the students from Koźmiński University to have the final photo with our teams. Come on, guys. And on behalf of Koźmiński University community, I would like to thank the two teams for huge effort. Thank you very much.